5 o'clock then.
Well, we go to cash book, AS accounting. For the cash book, when we talk about the cash book, it's part of a double entry system. So what do we use the cash book for? For both bank and cash transactions. So on the debit side of the cash book, you're going to have cash received and bank check received on the debit side. And on the credit side, you're going to have cash payments and check payments to your suppliers or contractors. That is about the cash book. Then we'll go to 3-column cash book. For 3-column cash book, the difference between the cash book and the 3-column cash book is that the 3-column cash book has discounts. So discount allowed on the debit side, discount received on the credit side. That's the difference. Is it clear?
Mm-hmm.
Do you understand that now, please? Do you get the point I'm making?
Yeah.
Okay, done. So discount allowed on the debit side, discount received on the credit side. We move on. So we go to a discount. When we talk about discount is the deduction made in the sale or purchases of a product. Deduction made on the sale or purchases of a product. That is what discount is. I think it's clear.
Yeah.
Then we have discount allowed, discount received. Both discount allowed and discount received are cash discounts. So discount allowed means the business accepts an amount lower than the invoice value.
Discount received.
Discount allowed means that the business accepts an amount lower than the invoice's value.
Okay.
That is discount allowed.
So lower than the market price.
More than the amount you are supposed to pay, the amount on your invoice.
Oh, okay.
The amount you are supposed to pay is on the invoice. But when you are paying less than what you have on the invoice, that is discount allowed. Okay. Then discount received means the supplier has reduced the amount you are supposed to pay. That is discount received. Is it clear? Mm-hmm. Is it clear, please?
Yeah.
Okay. So both of them are cash discounts, and both of them encourage both of them encourage prompt payment. So we move on. For trade discount, we call it trade discount.
This is one in a business.
Because it's a reduction because you purchase in bulk. For bulk purchasing. So businesses give trade discounts to encourage bulk purchasing.
Like when you buy like a lot of stuff, when you trade, that's trade.
When you buy large quantities and at a reduced price that is trade discount.
A lot of, yeah, I understand.
That's what we call bulk purchasing, that's the trade discount. Then we'll go to end of period transfer and adjustments. Please be focused here, please.
I'm focusing, perfect. Thank you.
At the end of the accounting period, the double entry accounts need to be balanced as they are needed to prepare the financial statement. So why do we have the end of period transfer and adjustments? Because as soon as we prepare our double entry system, we need to balance them because we need the final figures to go to our statement of profit or loss, to the general ledger, and to the statement of profit and statement of financial position if it is assets and liabilities. I'm going to say it again. We need to balance our ledger, the general ledger, which has revenue and expenses, and assets and liabilities. All these balances has to go to the statement of profit or loss and statement of financial position. Revenue and expenditures goes to your statement of profit or loss and other comprehensive income. In our general ledger, where we have our insurance, all expenses and all revenue. Expenses and revenue. In the general ledger, you prepare a ledger for these accounts, right? So in this ledger, the balance. When you balance up your ledger, you take the final figure to the statement of profit or loss for revenue and expenses. For assets and liabilities, it goes to your statement of financial position.
So for expenses and revenue, it goes to profit
statement
or loss.
Of profit or loss.
And for
assets and liabilities, it goes to your statement of financial position. Is it clear?
Yes, sir.
That is why we make adjustments. Done. Then we go to irrecoverable debts. For irrecoverable debts and allowance for provision for irrecoverable debts. Irrecoverable debt occurs when a debt has to be written off as a credit customer didn't pay back. So we have irrecoverable debts because the credit customer was unable to pay back. He or she is declared bankrupt.
Oh.
That is irrecoverable debt. Do you understand? So the debt has gone bad. Is it clear, please?
Yes, sir.
So if the debt goes bad, it means we need a double entry there. So we're going to debit the irrecoverable debt account and we're going to credit the trade receivable account.
Debit credit.
Is it clear or not?
Yeah.
So we'll move on. So this means the expenses of the business will increase, which is posted in the statement of. As soon as you have an irrecoverable debt, it increases your expenses as a business. So that goes to your statement of profit or loss and other comprehensive income. At the same time, double entry, yes.
How would you do a statement of profit or loss when the debt is not even your money?
The debt you sold, have you forgotten that you sell on credit? to a customer who is not paying back. Because the customer doesn't pay back, you have to pay back. It becomes an expenses for you.
So it's expenses for me. So I have to do a profit or loss.
It has to be part of your statement of profit or loss as expenses.
Okay.
Done. So your trade receivable, which is supposed to be part of your statement of financial position, will be reduced with the same amount that it becomes your expenses.
Okay.
Before now is your trade receivable. Your total of trade receivable goes to your statement of financial position. But as soon as one of your trade receivables are not going to pay back, it becomes an expenses for you. So you add it up to your income or to your statement of profit or loss account, and you deduct it from your trade receivable in your financial statement of financial position.
Okay.
They are in your trade receivables, but the debt has gone bad. So it means your trade receivable will be reduced because your expenses has increased.
Okay.
Is it clear? Is it clear, please?
Yes.
So we move on.
Allowance provision for.
Yeah, it's the same as that. Provision for depreciation provision for irrecoverable debt means that you have made provisions, you have made allowance in case the debt goes bad. So as soon as you are selling on credit, as soon as a business sells on credit, it needs to make provision for bad debts. Yeah?
Write it down.
No, it's there. I wrote it already.
Oh, sorry. This is okay. Perfect.
Yeah. So as soon as the business, both of them are the same.
Oh, it seems so.
Yeah. So what they are just trying to tell us is that as soon as the business goes bad, as soon as a business sells to a credit customer, you should start preparing for provision for doubtful debts or bad debt, because not all the customers will pay back. And even if they pay back, they might not pay back at the right time. Yes.
There's something called non-current liabilities and current liabilities.
Non-current liabilities are liabilities that stays more than a year. That's example, loan.
What if we don't have not current liabilities? How do we do for this?
If you don't have, you don't have. But there's no business that would not have a non-current liability.
Okay.
How do you start your business? You have capital. You're starting the business with capital. So it's part of your liability. Okay. Is it clear? Is it clear, please? So go to activity 8. Are you there?
Yeah.
So it's IAS Electrical decides that 5% of all trade receivables are assumed to be irrecoverable debts. So it means it assumes that all its trade receivables will have 5% irrecoverable debts. And accordingly, so you are told that the trade receivables balances are as follows. In December 2016, 50,000 was the trade receivable. In 2017, 60,000. In 2018, 40,000.
How do you know?
That is the analysis. That was the case study. So they said, show the relevant ledger accounts for the allowance provision for irrecoverable debts for each year. Also indicate what amounts will appear in the statement of profit or loss and other comprehensive income and the statement of financial position at each end of each year. So we start first on 31st of December 2016.
Why don't you do a ledger?
Look at, please, just calm down, okay? What they said we should do is what I did, so just calm down, please. So at 31st of December 2016, there's a trade receivable of 50,000. Take that off, sorry.
I can't.
You can't, sorry.
Sorry.
At the end of 31st December 2016, there's a trade receivable. Please be focused here. There's a trade receivable of 50,000, which means there's 5% on trade receivable of 50,000. So 5% of 50,000 is 2,500. So our irrecoverable debt for 2016 is 2,500. Do you understand now? Because you're not here, please be here.
So I'm here, but you're just playing really fast.
At 31st December 2016, based on the case study here, there's 50,000 trade receivables, which goes to your statement of financial position. But 5% of it is considered as irrecoverable debt.
So that I cannot get anymore.
So 5% of it, which is 2,500.
Okay. So every year. So you must
each year. So just calm down, please. For the first year, 2016, we have 2,500. So the 2,500 is the irrecoverable debt for 2016. Then, in the statement of financial position, you have to take 2,500 away from the 50,000, which I explained earlier, from the trade receivable. So your statement of financial position will have 47,500. It is 50,000 the trade receivables. 5% of 50,000 is considered as irrecoverable debts. It becomes expenses for the business. 2,500 becomes expenses for the business. At the same time, 2,500 has to be taken away from the 50,000. So your statement of financial position would now have 47,500 instead of 50,000. That is 2016. So your statement of profit or loss, which becomes an expenses, will have 2,500. Is it clear? In 2017, we have 60,000. The trade receivable is 60,000 in 2016. 2017.
Divided by
5% of 60,000.
By 100.
Hold on, please. 5% of 60,000, which is 3,000. So this means our trade receivable becomes 3,000. Here, it is 3,000. It means we just have to add 500 to the 2,500. Now, the balance of our trade receivable or our irrecoverable debt is 3,000 in 2017, which means 500 is added for 500 is added to 2016 trade receivable.
Okay.
It's accumulating.
Accumulating.
So we have 2,500 in 2016. Now in 2017 we have 3,000. But you won't write 3,000. You minus it, so you have 500.
Yes.
So 500 is added to the trade receivable in 2017.
Why don't you do 2018?
I'm going to 2018. This is 2017, please.
Okay.
Do you understand 2017 now?
Yes.
So in 2017, our statement of profit or loss will be added by 500. Then irrecoverable debt will be 60,000 minus 3,000. So our trade receivable will have 57,000.
Okay.
Is it clear?
Yes.
Now in 2018. In 2018, we have trade receivable of 40,000. Yes or no?
You're going to divide by 100 times it by 5%.
Can you please let me talk, please?
Yes.
5% of 40,000 is 2,000. Now, our trade receivable is supposed to be 3,000.
Yes.
It is.
So loss of 1,000.
A current balance in our account is now 3,000. And we need to only have what? 2,000.
2,500.
No, it's 2,000.
Yes, so it went down 1,000.
Now we have 3,000. We are having 3,000 instead of 2,000.
Yes.
Are you getting what I'm saying?
We have 2,000 instead of 3,000.
3,000, yes.
Yes.
The current balance in our statement, our recoverable allowance is 3,000, but it's supposed to be 2,000. This is our irrecoverable.
You said it's supposed to be 2,000. Where's 2,000 here?
I'm telling you here,
yeah,
but we are having 3,000.
Yes.
That's what I'm saying. Are you with me? So instead of the 3,000 cannot go because we need to have 2,000 based on here.
Yeah.
But the current balance in our allowance is 3,000. So what do? We take 1,000 away. We reduce the allowance by 1,000. So the 1,000 is credited in our statement of profit or loss, not on the debit side, on the credit side. Do you get what I'm saying? We are having a deficit now.
So it's not a loss?
No. We're having more than what we are supposed to have as allowance.
Okay.
So we reduce it. So we reduce the allowance by $1,000.
Yeah.
So therefore in 2018, the statement of profit or loss and other comprehensive income will be credited with 1,000 reduction.
Okay.
So now our expenses in the statement of profit or loss will be 1,000.
Do
you get it now?
Yeah.
Because we already have our expenses as 2,000. Do you get it now? So your irrecoverable debt on the credit side will have 1,000.
Okay.
Your expenses will have 2,000.
Okay.
Is it clear now? Is it clear, please?
Yes, sir.
So then, our trade receivable in the statement of financial position will be 40,000 minus 2,000. For each of the year, your 5% will be deducted from the trade receivable.
Okay.
For each of the year, the irrecoverable debt will be accumulating.
Okay.
That's the difference. Do you get it? Each of the year, for your trade receivables will be deducted by 5%, which goes to your expenses account. Each of the year, your expenses account will be accumulating.
Okay.
Is it clear? Is it clear, please? Yeah. So now we should prepare allowance for irrecoverable debts. So our allowance for irrecoverable debt is the analysis of what I have done here. So we're going to have for 31st of December 2016, the balance carried down is 2,500, which is the first one. 2,500. You see, the balance carried down is 2,500. Then our statement of profit or loss account, which will be credit, right?
Yes, sir.
We have 2,500. Is it clear? So your balance on 31st December 2017, your balance carried down for 2016 becomes the balance brought down for January 1, 2017. At the end of the year 2016, our balance carried down is 2,500 from the irrecoverable debts. So this goes to 2017, 1st of January 2017, as our balance brought down 2,500. Do you get it? Do you get it or not, please?
Yeah, a bit confusing.
Listen, this is our statement of profit or loss. We need to prepare irrecoverable debt accounts. The irrecoverable debt for 2016 is how much? I wrote it here, irrecoverable debt, 2,500. This is it, 2,500. Do you get it now?
Yes.
So, it will be on the credit side. Irrecoverable debts will be on the credit side. You are crediting these accounts. So your statement of profit and loss will have a balance carried down on the debit side for 2,500. In 2017, the balance carried down for 2,500 becomes the balance brought down. This is 31st of December 2016. It becomes the balance brought down for January 1, 2017 for 2,500.
Okay.
Now, in 2017, we have our recoverable debt of 500,
Okay.
which is accumulated, right? So your statement of profit and loss for 2017 will have 500. When you add it together, you have 3,000. Do you get it now?
Yes.
So 3,000 will become your balance carried down at December 31, 2017.
Okay, and then for
January 1, 2018, you're going to have it as a balance brought down 3,000.
Yes, we know. Okay.
Yeah.
Now
so
31 of
the credit of 1,000 that is more than our allowance becomes our statement of profit or loss for 31 December 2018. We have 1,000 difference.
So confusing.
Yeah, it's just okay. This is the 1,000 difference. Now, all our provisions are on the credit side. But now we are going to credit our statement of profit or loss, right? For 1,000. Because we're going to credit our statement of profit or loss for 1,000, we have to debit it in the allowance for recoverable debts.
Okay.
For that credit, it has to be debit here. For all these credits, it has to be debit here because our statement of profit or loss for expenses are always on the debit side. For expenses are always on the debit side, right? Then in your irrecoverable debts, you're going to have them on the credit side. For the statement of loss, for the irrecoverable debts of 1,000 allowance that is left, will be on the debit side of on the credit side of your statement of profit or loss. Do you get it now?
Yeah, okay.
So that's your allowance. Then the 1,000 will be there. Then the 2,000, which is going to be part of our statement of profit or loss as expenses, will be added. So at the end of it all, we have our 3,000. But in January 1, 2018, 2,000 is our provision for irrecoverable debts, which goes to our statement of profit or loss. 2,000 goes to our statement of profit or loss. 1,000 goes to the irrecoverable debts in your statement of profit or loss on the credit side.
Yeah.
Is it clear? Is it clear, please?
Yeah.
So that ends activity 8.
Mr. We should done example by slowly